In the fourth quarter of 2025, the world's central banks bought more gold than in any 3-month period in over 40 years, 200 tons. That's not a diversification strategy. That's a coordinated retreat. From what? And into what system are we transitioning? If you want intelligent analysis of what's happening to money before the headlines catch up, subscribe now and stay ahead of the curve. Let's be precise about what just happened. Poland acquired 90 tons of gold in 3 months. Turkey added another 75. India's central bank quietly purchased 50 tons through secondary markets, avoiding price impact. China, whose official reserves are almost certainly underreported, added at least 60 tons to declared holdings. Singapore's monetary authority increased reserves by 15 tons. Kazakhstan accumulated 22 tons. Even Uzbekistan, a country most investors couldn't locate on a map, bought 18 tons of monetary gold. This isn't emerging market nervousness. This is institutional knowledge expressing itself through balance sheet architecture. Central banks are the most conservative institutions on the planet. They move slowly. They telegraph nothing. They coordinate through Basel committees and IMF channels years before the public sees structural shifts. When they move in unison, when they abandon 4 decades of selling or stagnation and pivot to aggressive accumulation, they are not reacting to market noise. They are preparing for market structure collapse. The question isn't whether they know something. The question is, what timeline are they operating on that we can't see? Think about the speed of this shift. As recently as 2018, central banks were net sellers of gold. The conventional wisdom was that gold was a barbarous relic, a legacy asset from pre-modern monetary systems with no role in contemporary finance. Central banks held gold the way museums hold ancient artifacts, a curiosity, a historical footnote. Then something changed. 2019, net buying resumed. 2020, buying accelerated despite pandemic chaos. 2021, buying continued even as markets rallied. 2022, buying hit 50-year highs. 2023, buying reached 1,000 plus tons annually. 2024, another record year. 2025, Q4, 200 tons in 3 months. This is not random. This is not market timing. This is not portfolio optimization. This is preparation for a known event. And the central banks positioning most aggressively are the ones with the most access to global financial intelligence. Here's what most analysis misses. Central banks don't buy gold to make money. They're not speculating on price appreciation. They're not trying to outperform the S&P 500. They buy gold to survive monetary system transitions. Go back to 1971. The Bretton Woods system collapsed not because economists predicted it, but because the French central bank demanded physical gold redemption for dollars, exposing the system's fundamental insolvency. President Charles de Gaulle didn't trust American promises. He wanted metal. The central banks who held gold survived. Those who held only dollar promises did not. They learned a lesson that day. When the system breaks, paper burns and metal endures. Fast forward to 1997. The Asian financial crisis destroyed currencies across Thailand, Indonesia, South Korea. The IMF arrived with austerity conditions. Nations with gold reserves had negotiating leverage. Those without became economic protectorates. Thailand had to sell national assets. Indonesia faced social collapse. South Korea's citizens donated personal gold to save the national balance sheet. But the countries that maintained gold reserves, they negotiated better terms. They preserved sovereignty. When Lehman collapsed and the entire Western banking system required overnight life support, which institutions had actual collateral? Central banks with gold. The Federal Reserve established swap lines with other central banks, allowing them to exchange their assets, including gold, for emergency dollar liquidity. Without gold, those swap lines wouldn't have been possible. Without swap lines, the European banking system would have collapsed. Gold didn't just preserve wealth in 2008, it preserved the entire global financial architecture. This is the hidden pattern. Gold is not an investment for central banks. It's a systems failure insurance policy. And when you see coordinated, record-level purchasing, you're watching institutions prepare for the expiration of the current system's warranty. Now here's the critical insight most people miss. Central banks don't just look at economic data. They have intelligence access that private investors will never see. They attend Bank for International Settlements meetings in Basel, where the world's monetary authorities discuss systemic risks behind closed doors. They receive confidential IMF assessments of sovereign debt sustainability. They participate in Financial Stability Board stress tests. that model what happens when major currencies or financial centers fail. They know which governments are insolvent, they know which banking systems are fragile, they know which currency pegs are about to break. And for the past 6 years, they have been buying gold at an accelerating pace. What do they see? Now layer in what's happening simultaneously. The Federal Reserve's balance sheet is still holding $7 trillion in assets from pandemic-era interventions. They've attempted quantitative tightening, letting bonds roll off without replacement, but the pace is glacial, and the absolute level remains historically enormous. The European Central Bank is trapped between inflation fear and recession risk, unable to credibly tighten without breaking peripheral European bond markets. Italy's debt-to-GDP ratio exceeds 140%. Greece never recovered. Spain is one recession away from crisis. The Bank of Japan still owns more than half of its own government bond market. They've kept interest rates near zero for 3 decades. Their balance sheet relative to GDP is the largest in developed market history. These are not signs of monetary strength. These are signs of monetary exhaustion. Western central banks have fired every conventional bullet. Interest rates were held at zero for over a decade. Money was printed in quantities that would have been unimaginable to previous generations. Asset purchases distorted every market from real estate to corporate bonds. And what do they have to show for it? Inflation returning despite claims it was transitory. Debt levels that can never be repaid at current interest rates. Asset bubbles in everything from stocks to art to cryptocurrencies. Wealth inequality at levels not seen since the Gilded Age. Political instability, social fragmentation, and a complete loss of trust in institutions. This is not success. This is system failure in slow motion. And while Western central banks are paralyzed by their own balance sheet bloat and political constraints, Eastern and Middle Eastern central banks are reorganizing around hard assets. The People's Bank of China has been a net buyer of gold every single month for over 2 years. The official numbers show 60 tons added in Q4 2025 alone. But here's the thing, nobody believes the official numbers. China's gold reserves are almost certainly underreported. Why? Because admitting the true scale of accumulation would trigger market panic, spike prices, and undermine the dollar, something China doesn't want to do prematurely. They're buying quietly, consistently, relentlessly. The UAE's central bank quadrupled its gold reserves between 2019 and 2024, not gradually, aggressively. They shifted from minimal holdings to over 400 tons in 5 years. Singapore, typically conservative, typically transparent, increased reserves by 45% in the last 18 months and refuses to comment on the rationale publicly. Even Poland, a NATO member and EU participant, is buying gold hand over fist. Why? Because they remember what it means to be caught between empires without hard assets. They remember the partitions. They remember Soviet occupation. They remember hyperinflation. They will not be caught unprepared again. This is not a coincidence. This is a coordinated positional shift before a known event. Let me take you back to 1968. The London Gold Pool was an agreement between the United States and 7 other nations to suppress the gold price and maintain the 35 per ounce peg that anchored Bretton Woods. For 7 years it worked. Central banks sold gold into the market whenever private demand pushed prices higher. The system appeared stable. Economists declared the gold standard obsolete. Modern monetary management had triumphed. Then reality arrived. Under the surface, France was demanding physical delivery. Charles de Gaulle didn't believe American promises about the dollar's soundness. He wanted gold, and he wanted it now. Private investors in Europe were converting dollars to gold faster than the U.S. could print credibility. German citizens, remembering Weimar hyperinflation, were buying gold coins in bars. Swiss banks were facilitating gold purchases for wealthy international clients. The flow was relentless. Thousands of tons were leaving American vaults. By March 1968, the pool collapsed. Central banks stopped defending the price. Private gold markets spiked immediately. 3 years later, Nixon closed the gold window entirely, ending dollar-gold convertibility and ushering in the pure fiat era we live in today. The parallel to today is unmistakable. Right now, Western governments are insisting the dollar-based system is sound, that treasury markets are liquid, that inflation is transitory or controlled, but central banks in the global South and East are converting dollar reserves to gold at record pace. They are not selling into the market. They are removing supply from the market permanently. Think about what that means. Every ton of gold that moves into a central bank vault is gone. It's not coming back. Central banks don't trade. They don't speculate. They accumulate and hold. The global stock of monetary gold is approximately 35,000 tons held by central banks. Annual mine production is roughly 3,000 tons. If central banks are buying 1,000 plus tons per year, and they've been doing exactly that since 2022, they're absorbing 1/3 of all newly mined gold. Add in private investment demand, jewelry fabrication, and industrial use, and you have a structural supply deficit, but it gets worse. The gold coming into central bank vaults isn't just new mine supply. It's also gold being pulled from private markets, from ETFs, from bank reserves. When China's central bank buys 60 tons, those 60 tons came from somewhere. They came from the available float, from the tradable supply, from the pool of gold that investors and traders can actually access. And once it's in the People's Bank of China vault, it's never coming out. So the available float is shrinking, the tradable supply is tightening, and the institutions with the most information are the ones removing supply from the market. When this rebalancing reaches critical mass, when enough central banks have repositioned, there will be an announcement, a policy shift, or a crisis that makes the transition visible to everyone at once. By then, the gold will already be gone, and the price will reflect its new scarcity. Here's the irreversible dynamic now in motion. Every ton of gold a central bank buys is one less ton available to the market. Gold is not produced in meaningful quantities relative to global money supply. Annual mine production is roughly 3,000 tons. Total central bank demand in 2025 exceeded 1,000 tons. That means central banks alone absorbed 1/3 of global supply. Add in private investors, jewelry demand, and industrial use, and you have a structural supply deficit that worsens every quarter, but it gets worse. Once gold moves into a central bank vault, it almost never comes out. Central banks don't sell except under extreme duress. The UK sold half its reserves at the bottom in 1999, a decision still regarded as one of the worst financial moves in British history. Gordon Brown, then Chancellor of the Exchequer, authorized the sale between 1999 and 2002 at an average price of $275 per ounce. Gold today trades above $2,800 per ounce. That sale cost the British taxpayer tens of billions in foregone value. It's known as the Brown Bottom, the worst-timed asset sale in modern financial history. Every other central bank learned from that mistake. They learned, never sell your gold, never. So what you're watching is a one-way flow. Liquid tradable gold is being locked into institutions that will not sell. The available float is shrinking. And as the float shrinks, price becomes increasingly untethered from paper contract markets. Here's why. The gold market is actually two markets. There's the paper market, futures contracts, ETFs, unallocated accounts, where vast quantities of gold trade daily without any physical metal changing hands. Then there's the physical market, bars, coins, allocated storage, where actual metal moves. For years, these two markets traded at roughly the same price because arbitrage kept them aligned. If paper gold got too cheap, buyers would purchase paper and demand physical delivery, pushing the price back up. If physical got too expensive, sellers would deliver metal and pocket the premium. But that arbitrage depends on one critical assumption: physical gold must be available for delivery, and right now, that assumption is breaking. Delivery delays are lengthening. Vault capacity is tightening. Premiums for immediate physical delivery are widening. We are approaching the point where physical gold price and paper gold price diverge permanently. When that happens, when the paper market says gold is $3,000, but you can't actually buy physical metal for less than $3,500, the entire pricing structure collapses. ETFs will trade at discounts to net asset value because investors will realize they can't actually get the metal. Futures contracts will settle in cash because the exchanges don't have enough physical to deliver, and the price of real, deliverable, allocated gold will spike to levels that seem absurd by today's standards. Central banks are positioning before that break. They're buying physical, taking delivery, locking it away. And when the paper-physical divergence becomes undeniable, they'll be holding the asset everyone suddenly wants and nobody can get. So what does this mean for you? If you hold cash, you are on the opposite side of this trade. You are holding the asset that central banks are quietly exiting. If you hold bonds, you are holding promises denominated in currencies that central banks are hedging against. If you hold stocks in a system sustained by currency credibility, you are betting that this transition happens smoothly. History suggests it will not. Let me be very direct. The individual investor does not have access to the information flows that central banks have. You are not in the Basel meetings. You are not receiving the private IMF briefings. You do not have Treasury Department liaisons whispering about sovereign debt sustainability, but you do have the ability to read institutional behavior. And right now, institutions with the most information are buying gold faster than at any point in your lifetime. They're not doing it for profit. They're not doing it because they think gold will outperform stocks next quarter. They're doing it because they know the monetary system is transitioning and they know what happens to currencies during transitions. Let me give you a framework for thinking about this. Imagine you're at a crowded theater. Everything seems fine. The show is entertaining. People are comfortable. Then you notice something. The exits are getting crowded, not in a panic, just a steady flow of people moving toward the doors. You look around. Most of the audience hasn't noticed. They're still watching the show. But the people leaving, they're not random. They're the theater staff, the security guards, the people who work there every day and know the building better than anyone. Do you stay in your seat because everyone else is? Or do you follow the people who know something you don't? Central banks are the people who know the building, and they're leaving, not in a panic, not making a scene, but consistently, methodically, repositioning toward the exits. The question is whether you act on that signal before the reason for the signal becomes obvious to everyone. Because once it's obvious, the exits will be crowded. The price will have already moved. The opportunity to position will be gone. Right now, you can still buy gold. You can still take delivery. You can still build a position while prices are disconnected from the underlying supply reality. In 12 months, in 24 months, whenever this transition accelerates into public view, you won't have that luxury. You'll be buying at prices that reflect scarcity, competing with institutional capital that suddenly wants exposure, dealing with delivery delays measured in months, not weeks. The smart money is moving now. The question is, are you? Let's talk about who else is moving. Sovereign wealth funds, entities managing trillions in national savings, are reallocating. Norway's government pension fund Global, one of the largest in the world, increased its commodities and precious metals exposure by 12% in 2024. That's not a trivial adjustment. That's a strategic shift in a $1.6 trillion portfolio. When an institution that size moves, it's making a multi-decade positioning decision. Abu Dhabi's investment authority has been rotating out of European sovereign bonds and into hard assets. They're buying gold mining companies, physical gold reserves, even funding new mine development. Singapore's GIC, another massive sovereign fund, has been increasing real asset allocations across the board. Commodities, infrastructure, precious metals. These are not speculative hedge funds swinging for short-term returns. These are generational wealth vehicles designed to preserve purchasing power across decades and political regimes. They are moving for the same reason central banks are moving. They see the endgame of the current monetary architecture. At the individual wealth level, the same pattern is emerging. Billionaire family offices are quietly accumulating physical metal, not ETFs, not futures contracts, allocated, segregated, vault-stored physical bars. They're paying premiums for immediate delivery. They're accepting storage costs. They're prioritizing possession over paper claims. Why? Because when you have $500 million or $5 billion in liquid wealth, you're not trying to double it by speculating on tech stocks. You're trying to make sure it's still worth something in 10 years when the monetary system looks completely different. Ray Dalio has been publicly warning about debt spirals and currency debasement for 5 years. His fund, Bridgewater Associates, has been positioning accordingly. Long commodities, long inflation hedges, structurally underweight long-duration government bonds. Stanley Druckenmiller has called gold the best investment in a world of fiscal dominance, where governments spend without constraint and central banks accommodate without limit. Paul Tudor Jones has said he's long gold and Bitcoin because he sees the same macro endgame: currency debasement as the path of least resistance for over-indebted governments. These are not gold bugs. These are investors who built billion-dollar track records reading macroeconomic shifts before they become consensus. And they are buying gold, not because they love gold, because they distrust the alternative. Think about what that means. The most sophisticated capital allocators in the world, people with access to better information, better models, better advisors than you or I will ever have, are moving into the same asset that central banks are accumulating. That's not a coincidence. That's confirmation. And if you're waiting for CNBC to tell you it's time to buy gold, You're going to be buying at $5,000 per ounce after the crowd has already arrived. The opportunity is now, while the disconnect between institutional behavior and public awareness is still wide. Here's the moment of clarity. You are living through a monetary regime change, not a recession, not a market correction, not a political cycle, a structural reorganization of how the global economy stores and transfers value. These transitions happen once or twice per century. 1914, the classical gold standard collapsed under the weight of World War I financing. 1944, Bretton Woods established the dollar as the new global reserve, backed by gold. 1971, Nixon ended dollar-gold convertibility, launching the pure fiat era. We are inside the next transition right now, and the institutions that survive these transitions are the ones who recognize the shift early, who position before the panic, who understand that the old rules are already gone, even if the new rules haven't been announced yet. Let me tell you what happens to people who don't see these transitions coming. In 1971, anyone holding long-term bonds got destroyed. The dollar lost 30% of its purchasing power in 3 years. Bonds crashed, inflation spiked, wealth evaporated. But the people who held gold went from $35 to $200 by 1974, then to $850 by 1980, a 24x return in 9 years. Not because gold became more valuable, because the currency became less valuable and gold maintained its purchasing power. The same pattern played out in Weimar Germany, in Argentina during the 1980s, in Zimbabwe in the 2000s, in Venezuela in the 2010s. Every time a currency system breaks, paper burns and metal endures. The United States is not Zimbabwe. I'm not predicting hyperinflation tomorrow. But I am saying that the structural dynamics of dollar dominance are ending, the global reserve currency system is transitioning, and the central banks with the most information are preparing for that transition by buying gold. If you ignore that signal because it's different this time or the dollar is too big to fail, you are making the same mistake every generation makes before a monetary reset. You are assuming the system you grew up with is permanent. It's not. Nothing in monetary history is permanent, and the institutions that understand monetary history are buying gold. So here's what you do. You separate signal from noise. You ignore the analysts still defending the old system. You stop waiting for permission from institutions that profit from your inaction. You start building a position in physical gold and silver, not as speculation, as insurance against the monetary system doing exactly what central banks are preparing for it to do. Let me give you a practical framework. Start with 5 to 10% of your liquid net worth in physical precious metals, not your retirement accounts, not your emergency fund, your investable assets. If you have $100,000 in savings and investments, that's $5,000 to $10,000 in gold and silver. Prioritize allocated storage over ETFs. Allocated means you own specific bars with serial numbers stored in your name in a vault you can visit. ETFs like GLD are fine for trading, but they settle in cash during a crisis. You don't own the metal. You own shares in a trust that owns pooled metal. That distinction matters when the system breaks. For allocated storage, look at services like Bullion Vault, Gold Money, or traditional vaults like Brinks. You pay a small annual fee, but you own real metal that you can take delivery of if needed. If you want physical possession at home, buy recognized coins, American Eagles, Canadian Maples, South African Krugerrands. Avoid rare coins or numismatics. You're buying metal, not collectibles. For silver, the same rules apply. Coins or bars, allocated storage or home possession, recognized brands. And here's the critical part. This is not a trade. This is a position you build and hold. You're not trying to time the top. You're not trying to flip it for a quick profit. You're building a position in the asset that has preserved wealth through every monetary crisis in human history. When the dollar loses another 20% of its value, your gold doesn't. When treasury markets seize up, your gold doesn't care. When the next financial crisis hits and everything correlated to the dollar system crashes, your gold holds. That's the point. Not to get rich, to stay rich, to preserve purchasing power across a monetary regime change. And you do it now while central banks are still accumulating quietly before the transition becomes obvious to everyone. 1 in 200 tons of gold, gone from the market, into central bank vaults in 3 months. They are not coming back. The central banks know something. They're not speculating. They're not trading. They're preparing. For a monetary system transition that most people don't even know is happening. The information is public. The data is available. The pattern is clear. Central banks are buying gold at the fastest pace in 40 years. The only question is whether you'll figure out what they know before everyone else does, or whether you'll be asking what happened after it's already over, because by then, the gold will be in the vaults, the price will reflect the new reality, and the opportunity to position will be gone. 200 tons in 3 months, they know. Do you?